Welcome. Today we're taking a close look at Avidbank Holdings, ticker AVBH, a Silicon Valley commercial bank that went public on the NASDAQ in August 2025. This is a fundamental analysis based on their full year 2025 annual report and current market data as of April 2026. We'll walk through the company's history, profitability, growth, interest rate risk, credit quality, capital, valuation, and finish with a verdict on the stock. Avidbank was founded in 2003 as the Private Bank of the Peninsula and rebranded as Avidbank in 2011. It operates as the sole subsidiary of Avidbank Holdings and is headquartered in San Jose, California, with one full-service branch and loan production offices in San Francisco and Redwood City. What makes Avidbank distinctive is its dual focus. In the Bay Area, it's a traditional commercial bank serving small and mid-sized businesses with C&I lending, commercial real estate, and construction finance. But nationally, it runs three specialty divisions: venture lending, where it lends to technology and life science startups; asset-based lending; and sponsor finance. About 26% of its loan balances are now outside California. As of year-end 2025, the bank had $2.57 billion in total assets, $2.15 billion in loans, $2.19 billion in deposits, and shareholders' equity of $281 million, boosted by its IPO, which raised $61 million in net proceeds. Now let's look at profitability. On a GAAP basis, 2025 showed a net loss of $19.6 million, but that number is misleading. The entire loss was due to a one-time $62.4 million loss on the intentional sale of lower-yielding securities, which the bank sold using IPO proceeds to reposition the portfolio at higher yields. Excluding that item, adjusted net income was $24.9 million, or $2.80 per share. The operating picture is actually strong and improving. The net interest margin, essentially the spread between what the bank earns on loans versus what it pays on deposits, expanded from 3.44% in 2024 to 4.14% by the fourth quarter of 2025. That's a 70 basis point improvement in a single year. Return on assets on an adjusted basis was 1.06%, return on equity was 10.95%, and the efficiency ratio, which measures how much of revenue is consumed by expenses, lower is better, came in at 56.6%. These are solid metrics for a bank of this size. Growth has been consistent and entirely organic. No acquisitions. Loans grew 15% year over year to $2.15 billion, and deposits grew 12% to $2.19 billion. Importantly, non-interest-bearing deposits, the free checking and operating accounts, increased 34% year over year to $557 million. That's a sign of deepening client relationships and is very valuable because it lowers funding costs. Analysts are projecting approximately 12% loan growth for 2026, and the bank's new IPO capital gives it the runway to keep growing. Management's strategy is to expand its Silicon Valley franchise while building out its national specialty finance platform. Avidbank is an asset-sensitive bank, meaning it benefits when interest rates rise. Their own modeling shows that a 400 basis point rate increase would boost net interest income by about 16.6%. Even a modest 100 basis point rise adds nearly 4%. On the downside, a 100 basis point rate cut would reduce net interest income by only about 1.4%, a manageable exposure. That's partly because 52% of the loan book is floating rate, and about 22% of those floating loans are already at their floor rate, which limits how much income drops in a declining rate environment. And that $557 million in non-interest-bearing deposits, representing 25% of total deposits, provides a stable, zero-cost funding cushion that most community banks would envy. Credit quality is generally strong. Non-performing assets, loans that are no longer paying or foreclosed properties, stood at 0.95% of total assets, and net charge-offs were just 0.30% of average loans for the year. Non-accrual loans were only $2.7 million as of the third quarter. The Texas ratio, a quick measure of whether a bank's bad loans could wipe out its capital, is estimated to be very low for Avidbank, well under 10%. There are a few areas to watch. Management noted 3 loans were downgraded to non-performing status in the fourth quarter of 2025, and criticized loans, a broader measure of stressed credits, were running at about 1.5% of the portfolio. These warrant monitoring, but are not alarming at current levels. The higher risk loan concentrations are commercial real estate and construction in the Bay Area, and venture lending nationally. Venture loans carry higher risk, but also command premium yields of 7% or more. On capital, Avidbank is classified as well capitalized by regulators with a total risk-based capital ratio of approximately 13.5%, comfortably above the 10% well-capitalized threshold. The IPO significantly strengthened the balance sheet. Book value per share as of year-end 2025 was $25.66. The leverage ratio, total assets divided by equity, is about 9.1 times, which is reasonable for a bank growing at this pace. The one area of tighter liquidity is the loan-to-deposit ratio, which is running at 98%. That means nearly every deposit dollar is already deployed in loans. It's not a problem today, but continued loan growth will depend on keeping deposits growing in tandem. The strong 34% year-over-year deposit growth is reassuring on this front. At the current price of around $27 per share, let's look at what you're paying. The price-to-book ratio is approximately 1.05 times. You're paying just slightly above the bank's net asset value. For a bank with improving profitability and strong growth, that's a modest premium. The adjusted price-to-earnings ratio is about 9.6 times, using the $2.80 in adjusted earnings per share. That's below the typical regional bank trading range of 11 to 12 times, suggesting potential upside. Stated differently, the earnings yield, earnings divided by price, is about 10.4%, compared to a 10-year Treasury yield near 4.3%. That's a meaningful spread. Sell-side analysts are constructive. 3 analysts cover the stock with a buy consensus and an average price target of $33, representing about 22% upside. Stephens recently raised their target to $35. Morningstar, however, takes a more conservative view, suggesting the stock is trading at a premium to their fair value. It's worth knowing both perspectives. So, putting it all together, Avidbank Holdings is a well-run, growing community bank with expanding margins, solid credit quality, and strong balance sheet momentum following its IPO. At roughly $27 per share, just above book value and below the peer average PE, the price appears reasonable to attractive for investors comfortable with its profile. The key risks to keep in mind: the 3 watch non-performing loans, a tight loan-to-deposit ratio that requires continued deposit growth, concentration in the Silicon Valley tech and real estate ecosystem, and the normal sensitivity of any bank to a deteriorating credit cycle. That said, the fundamentals are moving in the right direction. For long-term investors willing to do the work on a smaller, less followed bank, AVBH merits serious consideration.